Most traders use too many indicators. They clutter their charts, give conflicting signals, and paralyze decision-making. In this video, I'm showing you the only 4 indicators you actually need, how to use them correctly, and which ones to delete from your chart right now. This is episode 8 of Zero to Trader Academy. Let's simplify your trading. Here's the truth, indicators are lagging. They're calculated from past price action. They tell you what already happened, not what will happen. Price action is king. Support, resistance, trend lines, those are real. Indicators are derivatives of price. Secondary. But used correctly, indicators can confirm what price is telling you. The key word is confirm. Not lead. The trap, adding more indicators doesn't make you more accurate. It makes you more confused. Professional traders use 2, maybe 3 indicators max. Beginners. They have 15 and still don't know when to enter. I started with every indicator TradingView offers. MACD, RSI, stochastic, Bollinger Bands, Ichimoku Cloud, you name it. My chart looked like a rainbow threw up on it. And I still lost money. Now I use volume and moving averages. That's it. My win rate went up when I deleted indicators, not when I added them. Volume is the most important indicator. Period. It tells you how much conviction is behind a move. High volume breakout, real. Institutions are participating. Low volume breakout, suspicious. Could be a fake out. High volume at support, buyers are stepping in. Good sign. High volume at resistance, sellers are stepping in. Watch out. Volume doesn't lie. Price can be manipulated. Volume shows you where the real money is moving. How to use it, compare today's volume to the average. Above average equals conviction. Below average equals caution. Moving averages smooth out price action and show you the trend direction. The 3 you need: 9 EMA for short-term momentum, 21 EMA for medium-term trend, 200 SMA for long-term trend. In an uptrend, price pulls back to the 9 or 21 EMA and bounces. That's your entry. In a downtrend, price rallies to the 9 or 21 EMA and rejects. That's your short. The 200 SMA is your bias filter. Above it, look for longs. Below it, look for shorts or stay out. Don't use moving averages as support/resistance by themselves. They're dynamic. Combine them with static levels. I trade QQQ. The 21 EMA is my best friend. In a trending market, I buy every touch of the 21. Doesn't work every time, but it works enough. Simple. RSI measures overbought and oversold conditions. Above 70, overbought. Below 30, oversold. But here's the key, RSI can stay overbought or oversold for a long time in a strong trend. Don't fade a trend just because RSI says so. Use RSI for divergence. Price makes a new high, RSI doesn't. That's bearish divergence. Reversal warning. MACD shows trend momentum and potential reversals. The histogram tells you if momentum is accelerating or decelerating. When the MACD line crosses above the signal line, bullish. Crosses below, bearish. But like RSI, MACD is lagging. Use it to confirm, not to predict. Here are indicators I recommend you delete: stochastic, Bollinger Bands, Ichimoku Cloud, parabolic SAR, ADX. Why? Redundancy. They tell you the same thing as volume and moving averages, just with more lag and more confusion. Your homework: open your TradingView chart. Delete every indicator except volume, 9 EMA, 21 EMA, and 200 SMA. That's it. Study how price interacts with these. Watch for confluence, when multiple indicators agree with price action. In episode 9, I'm walking you through your first trade, step by step. We'll use everything you've learned: support/resistance, order types, risk management, and these indicators. Bring your trading platform. We're going live. See you there.